We have Karen Dado, who is the New South Wales Director of Lloyds Business Brokers. Karen has over 30 years of corporate advisory, BD and consulting experience to company owners, CEOs and boards. Karen is going to be speaking to us today about enterprise value and also deal structure. Karen has extensive experience in acting for both buyers and sellers of businesses. On the seller side, she has provided advice in getting businesses ready for sale, including undertaken performance and risk reviews. And on the buyer side, she's been involved in DD, providing market and financial assessments. Karen has extensive experience, which includes over 15 years with PwC, both here and in London, and she also holds an MBA from the London Business School. She is also a licensed business broker. So I'd like to welcome Karen.
So my topic is talking about enterprise value and deal structure, but I'm really talking not from the technical side today. I'm talking from the perceptions and managing perceptions, and if you like, almost the emotional side of the deal when you've got especially family businesses that the owners, it's their baby, 30 years in the business, and it really puts a layer of complexity on trying to get consensus on deal value. And I'm just going to talk a little bit about some of the considerations, some of the challenges that creates, how we address the challenges, what's important in actually looking at how you maximise value if you're the buyer and getting ready for the sale, and then issues around the actual deal, around the structure, and issues like warranties and things like that sometimes get sort of buried in. They can get very excited about the price and forget that there's a lot of sort of terms and conditions and other legalities that need to be considered, that maybe on balance the price isn't that great after all, and how do you balance all of that up? And we'll give you some war stories as well. Lloyds has been in this business for over 35 years and got a lot of war stories. And then just wrap up with a little bit about Lloyds. So just moving on then. So here is my what I mean about the sort of the perception side of value, because you'll have a seller who'll come in and come to the broker, and they'll either have no expectation about the value, or they might say, well, it's definitely worth X. What's interesting is that rarely fits with what the buyer thinks is the value, and so we have a bit of a price gap, and I guess it's our job to try to close that gap, and it doesn't always succeed. You get buyers walking away, you get sellers refusing to deal with buyers. So and really the broker's role is to try to navigate the way through all of that. So perceptions, what shifts perceptions, and obviously what we're trying to do is we're trying to shift the buyer's perception up. Sometimes the seller's perception, yes, has to come down, but we certainly start with a position of trying to get the buyer to change their view about the value. And so what are the features that might come into play when you're trying to actually change perceptions? And this is a list of points that are all important considerations. And in actual fact, when you think about some of these points, synergies with the seller's business, or wanting to leverage the client base, or maybe wanting to get into a particular state where they're not at the moment, a target market, that really suggests, that's a trade sale, because there's a company, that's active, maybe not in that sector or maybe not in that state, and this would be a great way to fill out their offering. So that immediately comes to mind, that a trade sale is potentially where you're going to get your biggest, your highest perception. of value, and that often pans out in experience, and I'll come on to that sort of bit of a pyramid about value and who fits where later on. But that's certainly why the trade buyers are good targets, because there will be natural synergies that they're trying to actually leverage. But then other buyers will be interested in the more on the financial performance, and then you get into the sort of the private equity type of deals, and that's where what's driving them, they like the business, they like the sector, but they're really attracted to these profit figures that are going. You see growth year on year, you see margins improving. They often have criteria about EBITDA margins and returns, and so you start to attract with the right kind of financial performance. You'll start to get into attracting all those private equity and financial buyers. But at the end of the day, if they don't think that the technology or the market is attractive, or they don't think the people are the right people in the business, or they think that the people who are really key to the business might leave, or they might lose their customers, that's going to be all negatives. So all of those factors have to be managed. So the flip side is to say, well, what shifts the perception of value lower? And I just touched on some of those points, that there might be concern that they can't keep the key people. Sometimes it's a big challenge in family businesses where the owner wants to retire, but the buyer actually determines that the owner is the key person. And without the owner, everything else will disappear. And how do you manage that kind of dynamic when the owner might have left their succession planning a bit too late, and they might actually be 70 and in ill health, So these are all challenges that that the broker really has to navigate through. So and then the other thing that we see a lot of is this lack of systems. And it's quite interesting that businesses that have been around for 30 years, they haven't really systematised their business, and they haven't got a business plan, and so that really creates nervousness. And you think, well, we're going to have to make a lot of investment here to actually get this business running to a certain standard, and that's going to cost. But these are the sorts of things that we actually start to tell vendors that they should be thinking about in advance, because it will also result in improving their EBITDA margins. But it's an area that we find all the time is lacking. And then this issue of the profit. If it's not a nice steady growth, if it's fairly flat but the margins are kind of up one year, down another year, or some sales have dropped off, that's going to cause a lot of concern. And especially when the vendor wants to price the business on the last, but I did really well 2 years ago and 3 years ago, the vendor's going to look at the last 12 months. So, that creates a lot of tension as well in terms of determining value. And then the last point about the whole sort of supply chain and the value chain of the business, in terms of who are the suppliers to the business. Is it just one or two suppliers, and what happens if they drop off? Are your customers locked in, or is it just a sort of you haven't got any guarantee of future contracts? Can't quite determine where you are in the marketplace, can't get any information on the market, which is always a challenge in a private business. These are all things that contribute to shifting the perception of value lower. So here's this pyramid I talked about before, where at the top here, this is these typically trade buyers. For the reasons I mentioned, they're what we call strategic buyers, and in actual fact, that's where you're going to find the highest willingness to pay a bigger multiple. But it can be difficult to actually target strategic buyers, because many times the vendor will say that they don't want you to go out to the market, to the trade. They don't want the competition alerted. They don't want their customers alerted. So you can't even target the trade. in many cases. And I think of my last 3 or 4 deals, that's been the case. I've not been allowed to go to trade. So, but then they say, oh yeah, we recognise that this is probably going to be bought by someone in the trade. So say, okay, well, so what we tend to compromise on is to say that let's start with private equity, with accountants, with consultants, see where we get to, and then if we've got no traction, we will have to talk about how we go out to trade. So that's that interesting tension that exists. And then you get this sort of middle group here who will pay more than the sort of bottom feeders, but they still require a lot of effort on behalf of the broker to actually sort of really target them, because let's say private equity, they have very strict investment criteria, and that can include the sort of market sector that they're looking for as well, and the sort of returns that they're looking for. So it's still requiring a lot of targeting at this level. This bottom level, that's where you might see, almost, some brokers might say they've got, hundreds and hundreds of listings. Well, you'd have to say, well, you can't be doing a lot of strategic targeting if you've got hundreds of listings. And the way we deal with it is we try to work at this sort of these top 2 levels, and which means we don't take on a lot of vendors at the same time, so that we can really focus on understanding their market and actually doing some very, very focused targeting. So just moving on a little bit and talking about the challenges in valuing the business. Everyone wants, the first meeting you have is say, what do you think my business is worth? And it's interesting because, we do work along this continuum a little bit. I'm finding at the moment that a lot of businesses, let's say in the 6 million turnover, anything up to high ones in EBITDA, they've got intellectual property through customer contracts and their brand, but they're still in the 3 times EBIT area. So when we're looking at sort of the space we're in, very much is private companies, typically around the let's say 10 mil up to 10 mil turnover, we are working in this kind of price range, and very typically finding between 3 and 4 times. So, but we run an expression of interest process. We don't tell the buyer, we don't actually ever say what the price is, but it's part of managing the vendor's expectations to start saying, we think it's going to be worth X. And it's very interesting to say that some of the challenges in valuing the business, especially in the market I'm talking about, in the sort of this private market, it's very difficult to find comparables. It's not like dealing with a sort of a public listed company where you can get a lot of information. So we ask our vendors to give us industry information, and many of them do have useful information that we can refer to. So the other point, the second point there is a little bit what I started to refer to before, that vendors want to price in future sales. They want to, their forecast for the next year. They want that to include that. And this market doesn't do net present value and discount back. It's not that sophisticated, and the numbers are too unreliable. So the buyer will not look at forecasts, and so it's again managing the expectation of the vendor in terms of how the value is going to be perceived by the buyer. And that's to the third point, that the buyers actually want to see evidence of future contracts. And many times these family businesses, they're working on relationships and they don't actually have a lot of future contracts. Again, that's another challenge that's got to be managed. So a little bit on how we address these challenges. The point about, we position the business as a going concern. Looking at, very important to actually keep an up-to-date asset register, think about where the intellectual property is in the business, and start as the broker to develop a profile of the most likely type of buyer and have that conversation with the vendor quite early on. And then, start to look at these, what are the key selling points and the synergies for each buyer, as I was sort of referring to earlier. And then, of course, where are there sort of weaknesses or potential turn-offs, and how can you actually position the vendor to actually deal with those issues early on, and actually devise a strategy that can actually, be on the front foot when objections start to come through. So the sort of thing we say to the seller is be willing to make yourself redundant in the business. So a lot of buyers will say we're only looking for fully managed businesses, but they still want that owner to stay on and transition across. And sometimes they want them to stay on as employees as well. So, having that conversation with the vendor, many of them think they can just sell it and walk away in 3 months. Oh yeah, we'll stay and help for 6 weeks and then off we go. And that never happens in practice. And in actual fact, you get a lot of tension around the negotiation of the term sheet, where they've got this great offer, but they've got to stay in the business for 3 years. And they only have, and they earn out over the 3. Oh no, I don't want to do that. I don't want to stay around. So how do you manage that kind of tension as well? And if you don't get it right, that deal will fall over. Systematising the business, I talked to that before. Lots of opportunities to go in and improve these sort of smaller businesses in advance of sale. And, the business plan, you would think that would be a given. Certainly, big end of town, they always run off business plans, but this segment doesn't have a business plan. Some other points here around how do you actually improve the profit performance and document the profit performance, and all these things about documenting. Have you got the right tax advice? Are you producing monthly profit reports? Have you got obsolete stock? Where is your capital expenditure up to, and have you actually tracked annual capital expenditure? And you'd think these were all obvious things, but in many cases, the housekeeping, if you like, is not up to scratch. And stock I mentioned under the seller housekeeping, plant and equipment, that's the sort of the CapEx and the asset registers. Many times they don't have up-to-date asset registers on replacement values and so on. So, get that in place. Staff, are staff on contracts? Can they walk? If you've got key persons in the business, you don't want to have a risk that they're going to walk as soon as there's a new owner. And issues like even long service leave. Sometimes we've got staff, they've been in the business 20 years, they've never taken any long service. So there's this huge long service leave liabilities, which the buyer doesn't want to pay for. So, thinking about things like long service leave is important. Issues around the premises. I had one deal where you often get that the vendor owns the premises, and they want to sell it as well. We try to keep that quite separate, or they might want to lease it. And you say, well, yeah, but your business has only taken up 1/3 of this space. You expect a buyer to pay a lease on the whole value of the space. That's not going to happen. So then say, well, I want a buyer who's going to just take everything out of the business and move it into their own business. So then that very narrows who your potential buyer is. So they're all challenges that you've got to deal with. And looking up, making sure that everything, the balance sheet, long service leave liabilities I mentioned, but other issues to do with tidying up the balance sheet. And these are all considerations that, if they have a good accountant and a good tax advisor, it would all be dealt with, but many times that's just not the case. So here we have, this challenge of where you're going to land with your price. And are you going to be able to move your buyer up, or is the seller having to come down, or, a little bit of both? And we're trying to get to a price where the vendor doesn't walk away because they say, there's no way that's worth that, and or the buyer shuts down and says, I'm not going to even enter into discussion with that vendor because they're just way off. if you can prove the value of your business through having in place all the documentation and the disciplines that I've just gone through, you're going to have a much better case as a buyer for as a vendor for actually, influencing the buyer to increase their value. So here's a quote from an ex-investment banker. It's on a little bit of a different topic. It's talking about the deal structure, because this is another area where, we get certainly protracted negotiations around the term sheet, because you get owners obsessing over the price at the expense of terms. And, and that's true whether it's a minority or full sale. But if a vendor wants a higher price than the buyer is prepared to pay on the current numbers, they've got to be expect to have terms in there that are going to be an earn-out or some arrangement over the next 3 years with some EBITDA minimums to actually take risk out of it for the buyer. And owners don't necessarily get that. They want the higher price and they want the easy terms. And it's an inverse relationship, and that's one of the roles that the broker plays in actually managing that challenge. So just some points on what to watch about the deal structure, and what about if a buyer offers equity? So we basically suggest that if unless it's an ASX 200 company, equity's too risky for obvious reasons. I mean, there can be some stock protections with collar agreements to protect the movement whilst the transaction closes with floors and ceilings. But, in our market, family businesses around 10 mil, that starts to get, quite complex. So we tend to just say to the vendor very early on, and we put it in the IM, we want cash, and we stick with cash, even if that means a lower valuation. And the second point is seeking specialist advice on capital gains. We often find vendors are right within this 6 million enterprise value threshold, and sometimes it's worthwhile for them to take a lower valuation because they'll get a lower tax bill. And the other point about tax advice is why it's so important to get tax advice is around whether it's better for the vendor to do an asset sale or an equity sale. And there's all sorts of issues around whether they want to take all their cash out of the business. I mean, some of them have got cash in super funds in the business or trusts, and so it can be quite complex. And so earn-outs, that's what I was talking about earlier around sometimes the only way you're going to get the price up is through an earn-out. But the seller has got, the seller's concerned about decisions around whether they can control the future earnings in the business. There might be restructuring, loss of key employees, so how do you actually manage those kind of tensions? And I've again been involved in protracted negotiations about the term sheet just around the earn-out arrangements. Warranties and guarantees, these are important considerations that the vendor might not necessarily think about up front, but important to think about issues, some of the issues listed there. How do you actually, if you're going to warrant around key employees staying in the business, how do you actually make sure that that's implemented, or even customers? So they're all just complexities around what might be in the term sheet, and important for the vendor to realise and to get legal advice. Just to wrap up, just very, very quickly about Lloyds. We've been selling businesses for 35 years. We've got fantastic exposure nationally, internationally, fantastic database of contacts. Really all the private equity groups we deal with. All the business brokers are qualified professionals with deep backgrounds in either corporate advisory or law or accounting or business broking.